Hi, I'm Bill Spaulding. Welcome to WCS Money Tutorials. Many economists are expecting a recession soon. Evictions and car repossessions are increasing. The stock market is zigzagging to nowhere. What is the best way to invest now? This video will cover what I believe will happen in the next few months in the stock market and with the economy. I will discuss the best securities to buy and why you should buy them. I will also discuss the best way to buy these securities, how they compare to each other, and what to do after their prices spike. As you already know, interest rates are rising. These high interest rates will favor some securities over others and make other securities much riskier. Available credit will contract because interest rates are higher, which causes people to move their money from bank accounts to money market funds, where the money cannot be lent out as loans. Higher interest expenses will cause more businesses to fail. Higher interest rates also reduce the demand for loans, while debtors use more of their money to pay down their debt rather than to spend. Less spending means less sales for businesses, causing more layoffs, thus reducing spending even further, and so on. This is why recessions often follow interest rate hikes. One prominent sign of the increasing debt burden is car repossessions, which have been increasing rapidly. Debtors usually make car payments a priority, since cars can easily be repossessed, and most people need their cars to work. So car repossessions are a good sign that the economy is declining. This doesn't bode well for the stock market. So how should you invest? With the economy heading south and with the stock market meandering to nowhere, I believe that the best investments will be U.S. Treasuries with the longest durations and securities based on these treasuries. Now I will explain why.
To summarize, bond prices move inversely to interest rates. When interest rates decline, bond prices rise, and vice versa.
Duration is measured by the term of the bond and by its cash flow. Duration is an easy way to compare interest rate sensitivity of different bonds with different terms and cash flow, so that bonds with the same duration will have the same sensitivity to interest rates. Bonds with longer durations are more sensitive to interest rates than bonds with shorter duration. The key to making more money when interest rates decline is buying bonds with the longest duration that are free of credit risk. The longer the duration, the greater potential for capital gains when interest rates decline. This is the reason why the yield curve becomes inverted as interest rates rise, because investors want bonds with longer maturities to capitalize on the capital gains potential, thus increasing their price and decreasing their yield. People will prefer to buy ETFs rather than individual bonds, since ETFs have more liquidity. Buy only ETFs based on U.S. Treasuries or other sovereign bonds free of credit default risk. If the creditworthiness of bond issuers declines, then their bonds will also decline in price, including any securities based on those bonds, such as corporate bond ETFs, even if interest rates are decreasing. Interest rates often decline because of economic troubles, and many issuers of bonds, especially junk issuers, also run into financial trouble when interest rates increase or when the economy declines. If the economy does enter a recession, then the Fed will reduce interest rates to stimulate the economy, which will cause long-duration bonds to skyrocket in price. U.S. Treasuries and funds based on U.S. Treasury will also benefit from the flight to safety that often occurs when there's economic turmoil. Some of the best ETFs that will benefit from declining interest rates include the PIMCO 25-plus year zero coupon U.S. Treasury ETF, the Vanguard Extended Duration ETF, and the iShares 25-plus year Treasury Strips ETF. These securities are based on U.S. Treasury strips, which are free of credit default, just like Treasuries. Strips are created by stripping the cash flow payments from traditional Treasury bonds into individual zero-coupon bonds, each with their own CUSIP number. You cannot buy strips directly from the government. You must buy them from brokerages that offer them for sale. They are bought at a discount, just like Treasury bills. Interest is only earned at maturity. All strips are created and held in the commercial book entry system of brokers and dealers. The three ETFs that I am recommending are based on Treasury strips. These ETFs maintain a long duration by selecting only strips with the longest durations. Here you can see the Treasury strips that compose the Vanguard ETF. Note that each strip has its own CUSIP number, so they are treated as individual securities. You can also buy strips directly. Strips are not available at Treasury Direct, but you can buy them at many brokerages like Vanguard. For the greatest potential for capital gains, search for strips that will not mature until at least 2050. Then look at what is available with the longest maturity and with the best yield to maturity. Note that there are minimum quantities for both the bid and the ask, and the prices are for $100 of face value. However, keep in mind that strips do not have the liquidity of ETFs, since these are individual securities. The first security I recommend is the PIMCO 25 plus year zero coupon U.S. Treasury ETF. This has a long duration of almost 27 years and an SEC yield of 3.35%. Another similar security is the iShares 25 plus year Treasury Strips ETF with the same duration, expense ratio, and a slightly higher yield as the PIMCO security. The Vanguard Extended Duration ETF has a slightly shorter duration, a lower expense ratio, and a slightly higher yield than the first two securities. You can see in this graph that long duration securities decline when interest rates rise, which is why you see large negative values here. But when interest rates decline, then the exact opposite will happen. These securities will rise in price. When interest rates decline from about 2.4% down to nearly 0%, ZROZ and EDV both increased dramatically in price. GOVZ was not available then. Note that ZROZ rose about 10% higher at the peak of the COVID-19 pandemic, probably because of its slightly longer duration. Some people have asked me about 30-year Treasury bonds. While these bonds do have fairly long durations, they are not nearly as long as the securities I am recommending. The reason is because their periodic cash flows reduce duration, even though the maturity is 30 years. So while they will vary in price more than shorter-term securities, they don't have the capital gains potential of the longer duration securities. This graph reveals the difference. I added two ETFs based on 30-year Treasury bonds. As you can see, at the start of the COVID-19 pandemic, they did not rise nearly as much as the ETFs with longer durations. Another security you might want to consider is the 30-year Treasury Inflation Protected Securities, otherwise known as TIPS, that will be auctioned in August 2023. This security also has a long duration and offers a hedge against inflation, since its principal is adjusted according to the inflation rate. The August auction is a reopening, so it will have the same coupon rate of 1.5% as the 30-year TIPS that was issued in February 2023. But you will probably be able to buy it at a discount, which means that its yield to maturity will be higher. However, the exact yield will not be known until after the auction. Although this rate seems low, it is a real rate that exceeds inflation, unlike the nominal rate of most other treasuries. Another security I would like to discuss is the Direxion Daily 20-plus year Treasury Bull 3x Shares ETF, symbol TMF. This security targets the ICE U.S. Treasury 20-plus year bond index, designed to yield 3 times the return of the index on a daily basis. The duration is shorter than the securities already discussed, but it achieves its triple returns by using derivatives, making this security riskier than the others. As you can see from this graph of the index and the ETF, that the ETF did indeed deliver 3 times the results on March 6, 2020. As of 2023, the price of this security is near the lowest it has been since its creation. As you can see here, TMF was $15 in November 2018. Then it zoomed to $47 in March 2020. And you can see that its return was 2.5 times that of the PIMCO ETF. However, leveraged securities are considered riskier than regular securities, so you should read the prospectus before buying. Of course, the best time to buy these securities are when interest rates are near their peak, so right now seems to be the best time. Interest rates may rise another 0.25%, when the federal funds rate will range from 5% to 5.25%. Because there are clear signs of an economic slowdown, it is unlikely that interest rates will rise much higher than. Even though interest rates will probably rise a little further, long duration bond prices may not drop much because of the increased demand. The increased demand is why the yield curve becomes inverted. If you look at ZROZ and EDV, you can see their current price is higher than their low price in October 2022, even though interest rates have increased 1.5% since then. Since then, they have meandered within a narrow price range. In fact, even though interest rates have risen, these securities are up about 17.5% since those October lows. So it is probably safe to buy any time now, before interest rates start dropping, but you should buy in a certain way that I will discuss next. You can see from this graph that prices vary within a narrow band when interest rates do not change much. The best way to buy these securities is to set limit orders rather than using market orders. Set the limit order price within the low part band. A better way would be to set a limit order ladder, consisting of limit orders at different lower prices. Prices for EDV, for instance, have varied from $75 to $95, but it has only rarely dipped below $85. So one way to construct a ladder is to set a limit order for $84, another order for $83, and so on. Obviously, you could do this in many different ways, but it is obvious that the lower the price, the less likely the limit order will be triggered, so you will have to use your own judgment. My recommended securities will increase in price when interest rates decline. But some people ask, but wouldn't stocks also rise when interest rates decline? It depends. Interest rates will probably decline because the economy is slowing, which means that business will also slow. This will have a negative effect on stock prices. If another catastrophe occurs, such as a war with China, then the stock market will plummet while these long-duration securities will soar. Even if stock prices do rise, they will not rise nearly as much as these long-duration securities. These tables show the potential capital gains for these three securities. These prices were calculated by setting bond prices equal to the present value of $100 based on various interest rates. The important thing to note are the changes in prices as interest rates decline. If interest rates drop just 2%, the capital gains could exceed 60%. If interest rates drop 3%, then you may double your money. You might even triple your money if interest rates drop low enough. Note the values for the drop from 5% to 3%, yielding 68% for ZROZ and 60% for EDV. These are very close to the results of 2020, when rates dropped from about 2.4% to 0.25%. Actual results are about 4% lower than the prediction on my model. 30-year Treasury bonds will also increase in value when interest rates drop, but the capital gains will be less than the gains from the longer duration securities. You will also have to decide when to sell, but you do not have to rush. Interest rates will not change that quickly. If you monitor the news, you should get a good idea of where things are heading. Note two things about this graph. This graph shows the performance results of PIMCO, Vanguard, and another Vanguard ETF that tracks the S&P 500. The federal funds rate was at 2.25% to 2.5%. Then the Fed decreased the rate by 0.25% on August 1st, 2019, causing the PIMCO and Vanguard ETF to skyrocket 25% within a short time. Note that these two securities were doing much better than VOO, Vanguard Security, that tracks the S&P 500 index, even before COVID-19 arrived. Then, in March 2020, the Fed quickly dropped the rate by 1.5% as the COVID-19 pandemic was starting, which caused the PIMCO and Vanguard ETFs to skyrocket in price while the stock market plunged. This may happen again. If there is another economic calamity, such as another pandemic or a war with China, then prices for securities based on U.S. Treasuries will spike, while stock prices will plummet, just as they did when COVID-19 pandemic arrived in 2020. Interest rates will drop quickly, and Treasury-based securities will zoom in price, not only because of the drop in interest rates, but also because of the flight to safety. If that happens, then sell the spike to buy stocks at rock-bottom prices. If the spike does not happen, then you can set limit orders to sell at various prices in the upper trading range of these securities. Once interest rates are near zero, then long-duration securities will have the highest interest rate risk, since interest rates can go no lower, only upward. This is the time to sell long-duration securities and buy stocks. The Federal Reserve is expected to raise interest rates again by at least 0.25% in its meeting on May 3rd, and possibly again on June 14th. Even if you buy now, you will likely make a good profit. What you can do is to set limit orders to buy some soon, and then set more limit orders after June 15th, which may be the final interest rate increase. But keep monitoring the Federal Reserve, reading the news from each of the FOMC meetings to see if you think there will be further increases in interest rates. Even if there are more interest rate increases, the higher interest rates may not depress the prices of my recommended securities by much. Since these securities are such a tremendous investment opportunity, the demand may be great enough to keep prices higher, regardless of interest rates. Such was the case since October 2022. Nonetheless, the Fed meetings will probably cause a great deal of volatility in bond prices. This is why it makes sense to set limit orders at various prices. You rarely see opportunities like this, where you can earn good interest while still being able to look forward to great capital gains, potentially much greater than gains in the stock market, even in the best of times, at virtually no risk. This is a rare exception to the adage that great returns require taking great risks. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.